Introduction. At the heart of every accurate and reliable financial report lies the accounting cycle, a systematic process used to identify, record, and summarize a company's financial transactions. A critical part of this cycle is the use of adjusting entries, which ensure that revenues and expenses are properly matched within the correct accounting period. This module will guide you through the full accounting cycle and give a comprehensive understanding of how and why adjusting entries are made to keep financial records accurate and compliant with accounting standards such as GAAP and IFRS. The accounting cycle, an overview. The accounting cycle is a series of steps performed during each accounting period to ensure proper recording, classification, and summarization of financial data. Steps in the accounting cycle. Identify transactions. Record transactions in the journal, journal entries. Post journal entries to the ledger. Prepare unadjusted trial balance. Prepare adjusting entries. Prepare adjusted trial balance. Prepare financial statements. Close the books, closing entries. Post closing trial balance. Each step ensures that the accounting records provide a faithful and complete view of the company's financial performance. What are adjusting entries? Adjusting entries are journal entries made at the end of an accounting period to ensure that income and expenses are recorded in the correct period, in accordance with the accrual basis of accounting and the matching principle. Without adjusting entries, revenues may be understated, expenses may be overstated or understated, assets and liabilities may be misrepresented. Categories of adjusting entries. There are 4 primary categories of adjusting entries. A. Accrued revenues. These are revenues earned but not yet recorded or received. Example: a consulting firm completes a service on March 28th, but hasn't billed the client until April. An adjusting entry is needed in March. Journal entry: doctor accounts receivable credit service revenue. B. Accrued expenses. These are expenses incurred but not yet paid or recorded. Example: salaries for the last 5 days of December are to be paid in January. Journal entry: doctor salaries expense credit. Salaries payable. C. Deferred revenues, unearned revenues. These occur when cash is received before services are rendered. Example: a school receives 300,000 naira in December for classes that start in January. Initial entry: Dr. Cash Kiar. Unearned revenue adjusting entry in January: Dr. Unearned revenue Kiar. Tuition revenue D. Prepaid expenses. These are payments made in advance for expenses that will benefit multiple periods. Example: rent of 120,000 naira is paid in advance for 12 months in January. Initial entry: Dr. Prepaid rent, Kiar. Cash monthly. Adjustment: Dr. Rent expense CR, prepaid rent. Depreciation and amortization adjustments. Depreciation adjusts for the wear and tear of tangible assets like vehicles and equipment. Amortization adjusts the value of intangible assets like patents or trademarks over their useful lives. Example: depreciation entry: Dr. Depreciation expense credit. Accumulated depreciation. These adjustments ensure the value of assets is fairly presented over time. Adjusted trial balance. After all adjusting entries are recorded, an adjusted trial balance is prepared. This is a critical step before generating financial statements. Why it matters. Reflects accurate balances of all accounts. Helps detect errors before reporting. Ensures compliance with matching and revenue recognition principles. Closing entries. After financial statements are prepared, closing entries are made to zero out temporary accounts, revenues, expenses, dividends. Transfer their balances to retained earnings, a permanent equity account. Closing entry example: Dr. Revenue crore, income summary. Dr. Income summary crore. Expenses: Dr. Income summary, net profit crore. Retained earnings. Post-closing trial balance. This is the final trial balance prepared after closing entries. It contains only permanent accounts, assets, liabilities, and equity, and is used to begin the next accounting period. Importance of adjusting entries in real life. Failure to make adjusting entries may lead to inaccurate profits, mislead investors and regulators, result in financial misstatements and penalties. Case study. Example: A real estate firm collected 1 million naira in January for a 10-month lease, but failed to adjust for the unearned portion monthly. At year-end, revenue was overstated by 200,000 naira, misleading stakeholders about the company's performance. Summary. Module 5 explored the accounting cycle, focusing on the critical role of adjusting entries in ensuring the integrity and compliance of financial statements. Whether dealing with unearned revenues, accrued expenses, or prepaid items, understanding when and how to adjust journal entries is essential for accountants and financial professionals.